Hello investors, this is Lukasz Labedzki, Senior Analyst at the Franklin Templeton Institute. Each week we'll cover the most important developments for investors, we'll look at what happened and how it impacts the markets so you can make smarter, more informed investment decisions. Today, I would like to walk you through the global bond markets and the key dynamics we are seeing in the data. Let's start with a standard risk-return chart where the x-axis represents risk and the y-axis shows total returns. The period we are looking at starts at the beginning of 2024. That's after the rate hiking cycle in both Europe and the United States. The chart itself is standard, but what the data tells us is unusual compared with what most investors are accustomed to. What can we see? As far as global fixed income is concerned, we can see that global treasuries have been the most volatile while delivering the lowest returns. In contrast, global high yield has delivered the lowest volatility and the highest returns, with global investment grade somewhere in between. In an ideal world, financial theory suggests that more volatility should lead to higher expected returns, but that hasn't applied to fixed income lately. Looking at the United States, green dots, we see a similar pattern. Here we focus on short-term treasury bonds to match their duration profile with US high-yield bonds. Even these short-term treasuries have delivered the lowest returns with the highest volatility relative to credit. And Europe is no different. See the purple dots. Some investors may ask, is credit a new safe haven? The data shows that corporate bonds have recently delivered higher returns at lower risk than government bonds. But is this a structural change? I wouldn't go that far. That said, several factors are supporting corporate debt right now. We are seeing significant volatility on the geopolitical and macroeconomic fronts, as well as fiscal concerns regarding the public sector. This puts pressure on government bonds, particularly long-term ones. At the same time, many corporate issuers are reducing their debt, which makes their balance sheets look relatively healthy. What's worth highlighting in this context is how the high-yield sector has evolved over time. It's definitely less risky now than it used to be, both in terms of duration and credit quality. Our slide, based on the US market, illustrates this. The left-hand chart illustrates that duration has steadily fallen and is now under 3 years, indicating low sensitivity to interest rate changes. The chart on the right, showing the breakdown by credit quality, indicates that most of the high-yield universe now consists of BA-rated bonds, the highest rating category within high yield. Overall, the risk profile has improved significantly. A common pushback we hear is that credit spreads are currently very low, meaning markets might not be pricing in much risk. And yes, as you can see on the left, the green triangles representing the latest credit spread readings sit close to the bottom of their 10-year ranges. But at the same time, total yields shown on the right remain attractive. They are above their historical medians, and even when compared across fixed income segments, they remain on the high side. The tug of war between spreads and yields continues. Which of these measures is more important? Well, we believe both are relevant for investors. So what's the bottom line? The bottom line is that In the current environment, attractive yields combined with low duration and solid fundamentals provide a cushion against potential adverse moves. Additionally, any potential widening of spreads presents investment opportunities and the chance to build exposure to the sector at more attractive prices. Thanks very much for listening. Trade well. Cheers.